I am going to give you a bar of silver, not a chart of silver, not a contract that says silver on it, an actual bar. It weighs 1,000 troy ounces, which is about 68.5 pounds. It is roughly the size of a house brick, only heavier than you expect when you try to lift it. It has a serial number stamped into the top, a refiner's mark, and an assay stamp certifying its purity. Tonight it is sitting on a steel shelf in a vault in London, under a ceiling you will never see, in a building whose address is not published. At this morning's price, your bar is worth about $68,790. Now here's the interesting part. At the same moment, on a screen in Shanghai, the same metal was pricing at $77,310 for the same 1,000 ounces. That is a difference of $8,520. Same weight, same purity, same day, just a different room. Your job for the next half hour is simple. Go and collect that $8,500. I am going to walk with you, and I want you to pay attention to the doors rather than to me, because every door you hit on the way is a piece of this market that no price chart will ever show you, and by the time you have hit all of them you will understand why an $8,000 gap can sit in plain sight for months while the best funded desks in the world walk straight past it. By the end I will also give you the number I counted myself, in bars rather than ounces, because ounces are an abstraction and bars are objects. Nobody publishes it in this form. You are watching the OG John AG. This is the backup channel of the only authentic and real OG John AG channel. Same person, same research, same data, not a light version of anything. On subscribing, let me give you the practical reason rather than the flattering one. Channels in this corner of finance disappear, sometimes with a reason attached, usually without a warning, and reach gets quietly throttled long before anything formal happens. There is exactly one defense against that, and it is redundancy. Redundancy is a thing you build before you need it, not after. Subscribing here is not a compliment to me. It is a second copy of an archive. Press it if the work stands up, and not otherwise. The second item takes 20 seconds, and it matters more. There are accounts running my name, my thumbnails, and in several cases a cloned version of this voice. Some attach affiliate links. A few have taken money from people who believed they were dealing with me. I am not going to build a segment out of complaining, because a complaint is worth nothing, and a method is worth something. Here is the method. The Patreon page attached to the main channel is the anchor. The link is in the description and in the pinned comment. If a channel, a group, or a link is genuinely connected to this work, it is listed on that page. If it is not on that page, it is not mine, no matter whose face is on the thumbnail. One page, one check, and you never have to guess again. Now the board. So we are all working from the same numbers. This morning, Wednesday the 26th of August, 2026, silver has traded between about $68.60 and $68.80 an ounce. It is up 8.6% on the week, 17% on the month, and 78.2% on the year. Gold closed yesterday near $4,640, up from $4,470 a week ago, which puts the gold to silver ratio a little above 67 and widening. The federal funds target range is 3.50 to 3.75%, with the effective rate printing 3.63. The 10-year Treasury sits at 4.70%, the 30-year at 5.23. The dollar index touched 98.55 on Saturday, its weakest in 3 months. That is the tape. Now take your bar and let us go and get paid. Door 1. Before you can sell the bar you have to establish that it is yours to sell. The London Bullion Market Association publishes vault data once a month, several weeks after the fact. The July report is now out. At the end of July, London vaults held 28,213 tons of silver, up 0.5% on the month, worth about $52.7 billion. And the LBMA gives you the detail that makes this video possible. It tells you the bar count. 940,423 bars. So your bar is one of roughly 940,000. Now the question nobody asks, which of those bars are for sale? The LBMA publishes how much metal is in the vaults. It does not publish who owns it, so you subtract. At the end of June, the last month with a full published breakdown, London held 902.8 million ounces. Of that, 622.2 million ounces sat inside exchange-traded funds and similar investment vehicles, allocated, bar numbered, held by a custodian against shares that somebody else already owns. What is left over, the metal not locked inside a fund, was 280.7 million ounces, 31.1%. So before you take a single step, the odds that your bar is even available to be sold are roughly 1 in 3. And if it is fund metal, do not assume you can talk your way in. That metal leaves the vault by exactly one route. An authorized participant hands back a block of shares and receives bars in exchange, And that participant only does it when the share price has fallen far enough below the value of the underlying metal to make the operation worth the cost. Read that carefully, because it is the most misunderstood mechanism in this market. Fund metal does not come out when silver becomes scarce. It comes out when investors sell the fund. A factory that cannot find an ounce anywhere in the world has no lever it can pull to reach that 622 million ounce pile. None. It is not hidden and it is not stolen. It is simply spoken for, and the only person who can release it is a shareholder deciding to leave. You are not an authorized participant. Door 1 is closed for 2 bars out of every 3. Let us say you got lucky, and yours is a free bar. Door 2. Try New York instead, because that is the market everybody watches. Approved COMEX vaults held 338.4 million ounces of silver as of the 24th of August. That sounds enormous until you split it. 99.2 million ounces are registered, which means warranted and genuinely deliverable against a futures contract. 239.1 million are eligible, which means the metal is sitting in the same building, meets the specification, and its owner has posted no warrant and has no obligation to anybody at all. Registered is 29.3% of the total. Eligible metal is in the building, it is not on the table. That distinction is the single most abused number in this entire space, and people who quote the total as though it were deliverable are either not reading the report or are hoping you will not. Now, is New York failing? No, and I want to be straightforward about that because it cuts against the dramatic version of this story. Over the last 30 days, 1,507 contracts were stopped for delivery, 7.5 million ounces, and every single one was delivered. Registered stock is up about 3% over the same window. Nothing broke. Nothing has broken. 5 years of confident predictions of an imminent delivery failure in New York have been consistently wrong, and I include some of my own earlier impatience in that. But hold the claims against the metal for a second. As of the commitments of traders date, Tuesday the 18th of August, total open interest in COMEX silver futures was 120,117 contracts, 5,000 ounces each, 600 million ounces of contractual claim, sitting on top of 99.2 million ounces of registered metal. 6 claims on every deliverable ounce. And that is not a scandal. Almost nobody stands for delivery. Most positions are hedges closed before expiry, and the commercial category is net short about 44,800 contracts precisely because those are dealers laying off physical inventory and forward sales, not speculators betting against the metal. 6-to-1 is normal in exactly the way a bank lending out most of its deposits is normal. Normal is not the same word as robust. It means the system works perfectly right up until the 6th person asks. Door 3, and this is the one that decides everything. Ship the bar to Shanghai. This is where I have to be careful, because I have explained this 2 different ways in the last fortnight, and each explanation was half of the truth. Let me give you the whole thing once, and then I am finished with it. The Shanghai Gold Exchange publishes its benchmark before tax. Western Spot is also quoted before tax. So when you see a premium of 12.4%, that is a genuine spread between 2 comparable numbers. It is not an accounting illusion. Anybody telling you the premium is simply the tax showing up in the price, including me a few days ago, has skipped a step, but now actually move the bar and meet the tax where it really sits. China applies a value-added tax of 13% on silver, not on gold. Investment-grade gold received a carve-out years ago. Silver never did, because Chinese law files silver as an industrial commodity, and industrial commodities pay the tax. Your bar crosses the border, and the tax is charged on its value. So let us do your arithmetic together in dollars, and you can rebuild every line of this. You bought your bar at the Western price, $68.79 an ounce. The tax is 13% of that, which is $8.94 an ounce. Your landed cost before you have paid for a single mile of freight is $77.73. Shanghai will pay you $77.31. You are 42 cents an ounce underwater. On your 1,000 ounce bar, that is $423 gone. Before insurance, before shipping, before the license premium. Now add the real costs. Logistics and insurance on high-value metal run somewhere around 20 to 50 cents an ounce. The import license premium runs another 50 cents to $1.50. Put those in and your loss on the bar is somewhere between $1,100 and $2,400. You have flown a house brick of silver 8,000 miles and paid for the privilege. And here's the part that makes this worth understanding rather than just memorizing. Stand next to a Chinese fabricator while you do it. He is registered for value-added tax. He buys metal, pays input tax, sells a finished product, charges output tax, and offsets one against the other. For him, the 13% is a cash flow item, not a cost. It moves through his books and out the other side. His cost on the same bar, on the same day, is around $69 to $71 an ounce. Its value to him is $77.31. he is up somewhere between $6,500 and $7,500. Same bar, same morning, same two published prices. One buyer is out roughly $1,500 and the other is up roughly $7,000. So the spread is real and the spread is not yours. Those are two different sentences and almost the entire internet collapses them into one. The premium is not a mirage and it is not free money. It is a fee for being the right kind of legal entity in the right country, and no amount of conviction about silver will convert you into one. Door 4. Suppose you found a way through anyway. Can the bar ever come back out? On the 1st of January this year, China's Ministry of Commerce retired the silver export quota system that had run since the year 2000 and replaced it with a licensing regime. To export silver out of China, you now need a specific authorization. 44 companies hold it for the 2026 to 27 period, up from 42 the year before. And look at what traveled in the same regulatory package. Tungsten, with 15 licensed exporters. Antimony, with 11. Those are not ordinary commodities in Chinese regulatory language. That is the drawer marked strategic materials, the one reserved for defense and advanced manufacturing inputs. Silver was quietly moved into that drawer in January. Most of this market spent the year pricing it as though nothing had happened. Now hold that against the import side, because the asymmetry is the whole point. In the first quarter of this year, China imported about 1,626 tons of silver, the largest first quarter on record. March alone was around 836 tons, 78% above February, and 173% above the 10-year average for that month, in freely and in size, out through 44 gatekeepers. That is not a market, that is a one-way valve, and a one-way valve does something very specific to a price. It is the difference between a premium that oscillates and a premium that ratchets. Metal flows east chasing the spread, which should compress it. When the spread inverts, the metal cannot easily flow back, so the correction never runs in reverse. The floor gets rebuilt every time it is tested, and it never gets removed. That is why an $8 spread survives for months on a metal that is fungible, storable, and shippable in a world full of extremely well-capitalized desks who are neither stupid nor asleep. Not because nobody noticed, because the return leg is licensed. Door 5. Fine. Forget China. Sell the bar to the other giant. India is the largest silver importer on Earth. In the last full Indian financial year, it brought in 7,335 tons, worth about $12 billion, which is roughly 1 ounce in every 5 the world consumed. India mines almost none of its own. Every ounce arrives from abroad. In January of this year, India imported 747 tons. In May, 46.8 tons. In June, about 29. On the 13th of May, the import duty went from 6% to 15%. In the middle of that month, most forms of silver were moved onto a restricted list requiring a license. In June, silver grain and powder were added. Most Indian banks still do not hold the permits, and the committee that issues them meets once or twice a month. And the reason had nothing to do with silver. The rupee has been the worst performing Asian currency this year, down about 7% and trading near 96 to the dollar. Crude reached $118 a barrel in April. India's oil import bill jumped 53% in a single month, and the trade deficit widened 37.3% to $28.38 billion. Delhi needed to stop dollars leaving the country, and silver was one of the largest discretionary outflows on the list. So the world's biggest importer of silver currently cannot legally take your bar either. Door 6. Sell it to somebody who actually needs the metal, a factory. World industrial demand for silver this year is 639.6 million ounces, 3% lower than last year. Expressed in your unit, that is about 1,750 bars consumed every single day, worldwide, in solar cells, electronics, brazing alloys, medical devices, and electrical contacts. That is a real buyer with a real need. But here is the problem with selling into it, and this is the strongest argument against everything else in this video. Your biggest customer is engineering you out of his product. Silver paste now accounts for somewhere between 10 and 20% of the total cost of a solar cell. When an input reaches that share of your bill of materials, you do not complain about it. You fund a team to remove it. Manufacturers are thrifting, which means using less silver per cell, and substituting, which means replacing silver paste with copper. LONGi, one of the largest solar manufacturers in the world, has moved toward copper metal as cells specifically because of the silver price, and suppliers are now shipping copper paste commercially. This is not a forecast, it is a measurement. Solar demand for silver fell 6% last year to 186.6 million ounces, and the World Silver Survey has it falling a further 19% this year to about 151 million. Sit with the size of that. The fall in solar demand this year is about 35.6 million ounces. The entire forecast global deficit for the year is 46.3 million ounces. One demand category is shrinking by an amount close to the size of the number the whole bull case rests on. Jewelry is forecast down 16% to 159.4 million ounces. Silverware down 20%. And understand who is making that decision, because it explains why it does not reverse. It is not an investor with a view on silver. It is a materials engineer whose only constraint is conductivity per unit of cost, and a procurement manager holding a contract signed at a price that no longer exists. Neither of them is bearish. Neither has an opinion on the metal at all. When the input price doubles, the instruction that comes down the corridor is to find out how little of it the design can tolerate. And that instruction is not withdrawn when the price falls back, because the redesign has already been paid for. My honest answer is a weak one. Substitution is real, and it is already inside every number I have quoted you. The 19% decline is not a warning about the future, it is a record of the present, and the deficit of 46.3 million ounces is what remains after that decline has been subtracted. The market is short of metal despite substitution, not in ignorance of it. But if copper conversion accelerates through next year, the deficit closes on its own, and none of the vault arithmetic matters. I cannot rule that out, and neither can anyone else. Door 7, and it is the only one that opens. There is one buyer who wants your bar precisely because of what it is not. It has no coupon. It has no issuer. There is no counterparty who has to stay solvent for it to remain worth something. On the 19th of August, United States federal debt crossed $40 trillion for the first time. 32.27 trillion of that is held by the public, 7.78 trillion between government accounts. The Congressional Budget Office thought this level would arrive in 2028. It arrived 2 years early. The government has borrowed $1.8 trillion in the first 10 months of this fiscal year, which already exceeds the whole of last year. In the same week, the Treasury announced it would at least double its buybacks of long-dated debt, from $2 billion per operation to $4 billion, running from the 9th of September to the 4th of November, concentrated at the long end. Long yields fell about 9 basis points on the announcement. Then they went straight back up. The 30-year finished that week at 5.23%, higher than where it began, having printed a 19-year high inside the same 5 sessions. The seller of the bond showed up as a buyer of the bond, and the price of the bond still fell. That is the buyer for your bar, and here is the concession that cost me something. That entire argument is a gold argument. Gold went from $4,470 to $4,640 in a week. Silver went sideways. The ratio has widened all month. Central banks buy gold. They do not buy silver. Silver rides that trade with more volatility and less conviction, and a meaningful share of what silver has done this month is simply beta to a gold move it did not earn. Now put the bar down and let us count. London holds about 940,000 bars. New York holds about 338,000. Call it 1,279,000 bars of silver visible in the entire Western system. Now count the free ones. London's free float of 280.7 million ounces is about 281,000 bars. New York's registered stock of 99.2 million ounces is about 99,000. Add them. 380,000 bars. Just under 1 bar in 3. The other 2 are behind a fund's allocation, behind an unposted warrant, or behind an owner who has told nobody they exist. And the world's factories consume 1,750 bars a day. 380,000 divided by 1,750 is 217 days. Every bar of silver in the Western system that is both findable and genuinely free to move, added together, is about 7 months of what the world's factories burn. Now the weaknesses, because I would rather name them than have you find them. The free float is a subtraction, not a count. Nobody walks the vault. The fund holdings are known and the total is known and the difference is inferred, and inside that difference sits central bank metal, dealer inventory, and private allocated holdings, whose owners are under no obligation to tell anyone anything. The London data arrives weeks late and covers only vaults that report. The July free float split has not been published yet by the source whose method I track, so the figure I just gave you is the June split laid against the July total, and I am telling you that rather than smoothing over it. And the bar count assumes standard 1,000-ounce bars, which the London figure confirms, and the New York figure only approximates. So here are the conditions under which a door opens, and I am wrong. If the Shanghai premium sustains above 13% for a full quarter, the tax stops being a sufficient explanation, and there is a genuine physical signal underneath it. Status, 12.39% this morning, open, and currently against the idea. If China widens the license list well beyond 44 firms or reverts to quotas, the valve has a door in it, and the premium should compress. Status, 44 approved through next year. If London's free float rises above 40% on 2 consecutive reports from the same method, the immobilization argument is dead and metal is genuinely returning. Status, 31.1%, and the float has been rebuilding rather than draining. That is a point against me. If registered COMEX stock holds above 100 million ounces for a full calendar month, New York is not the thin room I have described. Status: 99.2 million and grinding higher. Second point against me. If solar silver demand prints below 151 million ounces for the year, substitution is running ahead of every published schedule, and the demand side leaves. Status partially triggered against me already. 3 of those 5 are running clearly against my case, and the first one cuts both ways. I would rather say that myself than have you find it and reasonably conclude I was hiding it, and what none of this tells you. It tells you nothing about next week. On the 29th of January this year, silver reached $121.62 an ounce. By the 6th of February, it was near 64, nearly half in a week. Today it is $68 and change, about 43% below that high. Every structural fact in this video was equally true in January, and none of it stopped that. Lang brings the July Personal Consumption Expenditures Index and the second estimate of second quarter output. The Jackson Hole Symposium runs Thursday to Saturday, themed on financial innovation and payments, with Kevin Warsh giving his first keynote as chairman on Friday morning. The committee meets on the 15th and 16th of September, and notice what the argument is actually about. The July meeting held rates on a 9-3 vote, and all 3 dissenters wanted a hike, not a cut, a hike. Warsh can move silver several dollars inside an hour on Friday. He cannot issue a Chinese export license. He cannot tell you who owns a bar in a London vault, and he cannot put an ounce into a registered warrant. 2 different clocks. Rate expectations set the price of an afternoon. Vault arithmetic sets the shape of a decade. People get badly hurt confusing the two in both directions. The full working goes on the Patreon page attached to the main channel. The bar count with both reports normalized onto one sheet. The landed cost calculation line by line so you can check my 42 cents. The claims ratio built from the raw commitment date and the substitution tracker, following announced silver-free solar capacity against actual shipments, because that is the number most likely to prove me wrong. Be clear about what that is and is not. Nothing on this channel sits behind it. The videos come at the same pace either way. The free analysis is not the thinner version, and nothing today was a trailer for something withheld. If it is useful, it is there. If not, you have lost nothing. And that page is still the way you verify anything claiming to be connected to this work. So, where is your bar? It is exactly where it was when I gave it to you. On a steel shelf in London under a ceiling neither of us will ever see. You could not sell it in Shanghai without paying more in tax than the spread was worth. You could not sell it in India because the paperwork does not exist. You could not sell it to a solar manufacturer because he is busy replacing you with copper. And you could not have taken it out of a fund in the first place, because 2 bars in 3 were never yours to move. That is not a shortage. I want to be precise, because the word shortage does a lot of dishonest work in this business. There is plenty of silver. It is simply that most of it is owned, most of the routes are licensed, and the fraction that is genuinely loose is just under 1 bar in 3, or roughly 7 months of what the world actually uses. An $8,500 gap sat in front of you for 30 minutes, and you could not reach it. Now you know exactly why, and you can rebuild every number I used without asking me. That is worth more than a price target. Invest with logic, never with noise. OG out.